Hello and welcome to Kathmere Capital Management's mid-year 2020 Market and Investing Update. My name is Nick Ryder. I am the Chief Investment Officer here at Kathmere Capital Management. Just as a reminder, as many of you are well aware, Kathmere serves as the advisor to your retirement plan. Today's webinar, keep it relatively brief. We're going to provide an overview or a review of market performance during the first half of 2020, as well as share some of our thoughts on a topic that's been top of mind for many investors. Of course, that's the upcoming elections this fall. However, before we get there, as usual, we're going to review or kick things off by reviewing a selection of slides covering a handful of investment principles that we think all investors, both novice and seasoned alike, would be very well served to remember and always keep in mind. So the first of which slides presented here, many of you have probably seen in the past. This is JP Morgan's retirement equation. It's a personal favorite of mine, just given I like how what we see here is they highlight 6 of the main factors that are going to influence an investor's retirement savings outlook. And what I really like about it is that they group these factors into 3 categories based on the degree to which we as individuals or we as investors are able to control or influence each of these variables. It's important in my mind, just given that investing, as is so many other things in life, is very, very important that we, again, always focus on controlling those things that we can control while allowing those things that we have no control to not cause us too much stress or undue consternation over time. I'll start over on the right-hand side, kind of colored in gold. Importantly, these are the 2 factors that are entirely out of our control as investors or individuals. And incidentally, and perhaps paradoxically, these are the things that seem to receive the most of our attention, that cause the most of us stress for us. And of course, we're talking about market returns, so the day-to-day, month-to-month, year-to-year fluctuations in stocks and bond markets cause so much stress for so many of us, even though they are entirely beyond our control. The other side of it, obviously gaining a lot of attention routinely, particularly in light of today's environment, would be kind of policy. And so this could be taxation as well as just various benefit laws as it relates to the taxation of savings and benefits. Moving kind of around the circle in a clockwise fashion, you see a couple of things that we do have some control over, namely basically our ability to earn over the long haul. So this would be the amount of earnings we make as well as the duration of those earnings, namely how long do we remain in the workforce. The other side of things, we have some control certainly over our longevity. Again, both of these are some control in that there are other factors at play, but certainly the actions we take can influence these much more so than, on contrast, market returns or policy. And then importantly, focus on up there towards the top left of the cycle, 2 areas where we have total control. First of which is our spending and saving behaviors. How much are we stocking away during our accumulating years, and then ultimately on the flip side during our retirement drawdown years, how much are we spending out of our portfolios? And the other side of it, of course, then as it relates to portfolio construction, will be asset allocation. So the policy mix or the mix of assets we have within our portfolios, really namely to the 2 main asset groups of stocks and bonds, as well as in the location of those between the various types of taxable and tax advantaged accounts. So just a pretty basic slide here, but always one that I like to cover. It's just, as it reiterates or emphasizes, ultimately, why do we invest? And of course, we invest really to grow our capital to help us fund our future spending needs. And what we see on this slide is that stocks and bonds over the long haul have provided returns in excess of inflation and, importantly, cash-like investments. So what we present here is a summary of nearly a century of returns for U.S. markets, covering January of 26 through the end of 2018. And of course, this covers some very good times as well as very bad times. You've had 2 world wars in here. You've had financial crises intermittent out there, but you've also had periods of very strong growth. And this is kind of what we get as a summary over the whole period. And so starting on the left-hand side, we see that inflation, or the general tendency of prices to increase over time, and over the century period roughly has averaged about 3% a year. You can see in the purple box that cash and cash-like investments, you could kind of think of this as, investing in CDs or in money market funds, basically has kept pace with inflation over time and offered a tiny incremental premium over inflation. So, allowing some increase in purchasing power over the whole time, but not much really. And so really when we think about portfolio construction, we think for investors that are looking to grow their capital in excess of inflation, which is what's most important, you're really left with two predominant asset classes. You have bonds, which are simply, in this case, we're representing bonds by treasury bonds, so loaning money to the US government. You can see that by doing so and bearing a little bit of risk, so to speak, in terms of the fluctuation of principal on a day-to-day basis. Investors of a very long haul have earned about a 2% premium relative to just stocking it away in CDs or money market like assets. And so about a 5% on average return over the very long haul. And of course, then for investors that are able to deal with even more fluctuation, we think the other main asset classes in most investors' portfolios is stock ownership, right? Owning shares or ownership interests in the companies of the U.S. market has earned investors a handsome return premium, so to speak, an extra 5% a year or 10% annualized over nearly this whole century through these ownership. And so it's for this reason that I continue to believe that stocks are the singular best investment option for long-term investors that are able to deal with the day-to-day fluctuations, which we'll talk to next. For those investors seeking to grow their capital over long periods of time, stocks really do remain among the best options for those long-term investors. Critically, though, while that previous slide showed a nice summary of a century of data, we know that on a year-to-year, quarter-to-quarter, even decade-to-decade basis, things can be quite a bit noisier. And so, honing in just on the stock market here, we try to make the point that stock market returns are rarely, though, quote unquote, normal or average would be the other side. And so what we show on this slide is taking 94 calendar years worth of S&P 500 or US stock market returns, and we break them out into various buckets on a year-by-year basis. And a couple of points that we see here, first of which we see in green and gray, we see that about 3/4 of the years over the last 94 years, stocks have delivered positive returns. Conversely, about 1/4 of the time they have delivered negative returns. Beyond that, though, we also see pretty what we'll call fat tails or wide distribution of returns. We see that on 6 different instances all the way on the left-hand side, stocks have delivered returns less than negative 20% in a given calendar year. Right, these are you can see the years listed on there. These are some of the very bad years that come to mind for many investors, namely in the bursting of the dot-com bubble in 2002, the depths of the financial crisis in 2008, as well as some periods there through the 70s and into the 1930s during the Great Depression. On the flip side, though, we also know that stocks have also had a number, and you can see actually on 35 different instances, stocks have delivered returns in excess of 20% in a calendar year. 2019 even most recently, as well as we also saw in 2017, where we saw very handsome returns for stock investors. Perhaps my favorite part about this chart, though, is they're highlighted in gray and with the text on the slide, is that we see that just 6 times, less than 7% of the time in the last 94 years, have stocks returned what I think most people will call quote unquote average, or within 2 percentage points either direction of that long-term average of 10% per year. So between 8 and 12%. And so this just underscores to me that, yes, while stocks over the long haul can be very great assets for compounding and growing our wealth, there is a lot of noise and a lot of variability that comes with it. And this is, I think, what most people think of intuitively as the quote-unquote riskiness of stock investing, which is it seems stocks are punctuated by these strong, sharp rallies as well as these massive and significant drawbacks, which, often coincide with economic downturns and other struggles in the broader economy. This slide here then, which comes from PIMCO, another great one that I really like, just tries to highlight in a hypothetical sense the risk of allowing our investment decisions to be influenced by recent performance. And so Just to orient everybody what we see on the slide, we see the blue line going from the left to the right on the slide, representing a hypothetical investment of 60% stocks, 40% bonds, your prototypical balanced portfolio, so to speak. And it runs from, it shows the growth of $100,000 invested at the beginning of 2006 over the subsequent 5 years through the end of 2010. So this period importantly covers, late stages of the bull market that ran in the 2000s, as well as then all of the pain that came with the global financial crisis and the sharp recovery that started in the early parts of 2009 and continued really until the beginning of this year, but covering the first year and a half of that to the end of 2010. And what we can see is that the 60-40 portfolio, as markets continued their march higher in 2006 and into late 2007, you see that initial $100,000 investment grew through time. And you can see an investor, that hypothetical investor, exclaiming, I'm so happy I invested when I did. What we also see on this chart, however, is the bars, which represent monthly net cash flows into Morningstar's category. So Morningstar is a fund data provider, what they call their moderate allocation category. So this is the category that balanced funds, of funds that have a similar allocation as 60% stocks, 40% bonds. And we can see that investors, by and large, were pouring money into these types of funds while the market continued higher. We can see that as markets started to fall in late 2007 and into 2008 as the financial crisis took hold, you see investors started pulling money from these funds. As you can see, negative monthly cash flows from these types of funds really starting in the late stages of 07 and continuing really in mass into the early parts of 2008. And you can see our hypothetical investor, after being quite so happy with their investment, starts to doubt things, hoping at first there's going to be a recovery, but we can see that investors in mass really started pulling money out towards the late stages of 2008. So we show now in the brown bar that kind of shows our hypothetical investor exclaiming, I can't take this anymore, I'm out. And that's happening right at the end of October of 2008. So shortly before the election, right after Lehman Brothers had failed, you were having other crises in the banking system with other investment banks going under, other companies really struggling at that time. And so investor bails, they sell their fund, they move into cash. And we can see that for a period there, they're quite happy as markets did continue to move down through the later part of the remaining few months of 2008 before ultimately bottoming in March of 2009. So our hypothetical investor missed a bit of this downturn, quite happy. They're skeptical then, even as markets start to recover sharply in March of 2009. You can see the blue line start to take back off upward. Meanwhile, our hypothetical investor comments on their skepticism of how the market will last. You can see that was generally held as a view, as very few investors were still pouring money out of their funds. Very few were starting to come back into these balanced type funds in the early stages of 09, and even as the rally continued through 09. But what we did see is that we move into 2010, and the market had now rallied quite strongly and sharply for a little over a year, and money started flowing back into the funds. And we see our hypothetical investor kind of mirroring that experience, saying, shoot, I better get back in. And they buy back in after a ferocious rally and do capture a good bit of that rally continued. But what we see is that this propensity of investors in mass to react to market performance ultimately costs them returns. So our investor that could have just been patient, disciplined, believed in the efficacy of their long-term investment plan and tried to eschew efforts to time the market, so to speak, their initial $100,000 investment ultimately came out to a little less than $112,000. Not a great return, but not awful. Still up 12% total over a very tumultuous 5-year period. In contrast, our hypothetical, what we'll call the emotional investor in PIMCO's slide here, ended up with less than what their initial $100,000 investment, after riding the market down, missed a good part of the market rally, and ended up down a little less than 7% over the period, and nearly a 20% shortfall relative to our disciplined investors. So hypothetical example for sure, but certainly guided by real world experiences, we do see these mutual funds. And it just does underscore the importance of really trying to stick to commit to a plan and remain disciplined through both good times and bad over this even tumultuous 5-year period. And so one thing, we'll just kind of close on the investment principles side here. Another favorite slide of mine just underscores this point of what we think one of the best risk management tools investors have at their disposal is to expand their investment horizon or expand their valuation horizon, and not to get too caught up on quarterly or annual returns, but rather really focus our investment perspective in alignment with our investment horizon, which for many of us saving for retirement is a multi-decade and not a multi-month experience. And so what we plot here is just the range of returns for bonds as well as stocks, and then a hypothetical 60-40 blend on rolling 1-year periods all the way on the left-hand side. And we can see that over the 70-plus years covered here, we see that bonds on a 1-year basis on average have returned about 6% a year. But you see on a 1-year basis, that's been as high as 33 and as low as -6. So you see stocks in the green bar averaged a little less than 11%, roughly 11% rounded over the 70-year horizon covered here. But we know very high highs and very low lows. So you've seen stocks return as much as 61% in a 1-year period, and you've seen them down as much as 43% in a 1-year period. And of course, then the purple bar, the hypothetical 60-40 mix, going to fall right in between them. But what's interesting, what I love about this slide is that as you shift out to the right on the slide and covering now, instead of a 1-year period, but rolling 5-year periods or rolling 10-year periods and ultimately rolling 20-year periods, is that the range of outcomes narrows considerably, in that the returns, the best 20-year periods, for instance, for stocks all the way to the right have delivered 18% a year. So quite a bit north of the average of 11% a year. However, the worst of periods still delivered 6% per year. So a considerable narrowing of that range of potential outcomes. And we think that if investors are able to expand their horizon, not get caught up in this attempt to time the markets, greatly increase their chances of success in realizing what we would consider to be average returns. And we can see that the same relationship holds for bonds over a 20-year horizon, and then, of course, for the balanced portfolio falling in the middle there. So one thing, takeaway for us is, again, just expand your horizon, do the best you can to remain disciplined, and you're far more likely to realize returns that now then resemble some of those averages we highlighted a few slides back. So with that, I'll turn our attention to the 2020 market update. Here we're going to cover just a selection of slides covering market performance for the first half of 2020. I'll draw your attention there to just the second column in. We can see on the year-to-date basis that the first 6 months of the years. U.S. stocks down 3% roughly. International and emerging market stocks down a little bit more, roughly 10% down. High-yield bonds, which are a hybrid security in our perspective that have some attributes of your traditional bond funds or bonds, as well as stocks down as well, down about 4% for the first 6 months of the year. And what you see is then at the bottom couple of rows, broad investment grade, high quality bonds up 6% on the year, shorter duration, short-term bonds up about 4%, in treasury bills, that T-bills representing kind of cash-like investments, basically holding flat. But what you see is that, of course, bonds and high quality investment grade bonds delivering in their role of providing stability and ballast to a portfolio during a tough time for equity markets for the year-to-date period. Turning your attention just to the far right side of the screen, covering longer-term 5-10-year results, you see pretty healthy returns across all asset classes. So it's been certainly over the last decade or so a pretty good environment for investors on the average, with U.S. stocks really delivering standout returns, international also positive, but not quite as high, in bonds even then still delivering quite healthy returns over the last decade. Slide 9 here just covers what probably resonates with many investors, that it really has been a tale of two quarters this year, or a bit of a feast and a famine as for investors. On the right-hand side, we can see the 10 worst quarters for the S&P 500 index since 1936. And you can see that the first quarter of the year ranks right up there among the worst, coming in at the 6th worst quarter we had seen during that 90-year horizon, as the market was down about 20% during the first quarter. We saw that famine, so to speak, followed by a very sharp reversal, and we see that the second quarter then there of 2020 ranked in at the 6th best quarter we've seen since 1936. So really a tale of two quarters, some very bad times followed by very good times. One thing I do like to point out on this slide is that, this experience of very bad being followed or very close by very good, not entirely unheard of. That gets referred to as volatility, quote unquote, clustering. We have seen similar instances in the past where very bad quarters have been mixed with very good quarters really nearby. We see coming to mind during the late 1930s, you saw a few periods like this. During the mid-1970s, shows up on these charts a few times, as well as even the late 1980s, where both good and bad times happen to occur very near one another. And again, this just underscores in our mind the importance of not reacting to recent performance, as the risk of missing out on a very good quarter is certainly very much a real risk following a very bad quarter. So something, again, just underscoring the point or the call for discipline in investing. The slide here just breaks out the performance during the first 6 months of the year by a little bit different lens, breaking into a couple of sub periods. So we saw a relatively speaking quiet first 7 weeks of the year. All the way on the left-hand side, we see U.S. stocks were up about 5%, reaching all-time highs on February the 19th. You saw international emerging market stocks basically flat, and then bonds had delivered some modest positively returns as well during that period. Of course, as we all know, in just an awful 4 weeks as the coronavirus really took hold across the globe, there beginning in late February and into the later stages of March. So just a horrible 4 weeks. Stocks down from their all-time highs, very swiftly down nearly 35%. International emerging markets, right there in line with it. The purple bar covers high yield bonds, and this is why I said high yield bonds are a bit of a hybrid between traditional investment grade bonds and stocks, in that they can deliver some handsome returns at times, but they certainly are not without their downside risk, which is why we tend to think of them more as a return generating asset, as opposed to what you see there in the two blue bars, both investment grade broad market bonds and short duration bonds, which held up considerably better during the crisis phase, really did deliver on the role of providing stability or ballast in a portfolio, basically holding flat during that period. Starting on March 24th, then shortly after the announcements of massive stimulus efforts coming from both the U.S. Government as well as the Federal Reserve, you did see markets rally very sharply. Beginning in late March, covering over really a 10-plus week there period through the end of the second quarter. You see U.S. stocks were up nearly 40%, international trailing close behind, but up north of 30. Again, then you see high yield bonds then reversing sharply, delivering some very positive returns, and investment grade bonds then both broad market and short duration kind of delivering some low single digits positive returns nonetheless. And then you see year-to-date period kind of summarizing again what we saw in the previous slide. We'll turn now, just kind of close things up with a topic that's certainly gaining lots of attention in investors' minds that we've received a handful of questions about recently, about the upcoming election. And our response is that we typically look to caution investors against allowing their political views to influence their investment decision. And it's for the simple reason in our mind that many of us allow our political affiliations or views to perhaps unduly or incorrectly influence our assessment of the economy. And so what we show here, and this is a chart from JP Morgan, based on some data or a survey continuously conducted by the Pew Research Center, which asks people about their assessment of the state of the economy, and also associates them their political affiliation. And what we see is over time is that party affiliation seems to have a very strong impact on our assessment of economic conditions. And so you can see that from 2000 through 2008 during the Bush presidency, Republicans on average tended to consistently rate the economy more favorably than Democrats. So you see the red line consistently ahead of the blue line, and this is asking the question of thinking about the nation's economy, how would you rate economic conditions today? And this is the response of people calling it excellent or good. And you see that Republicans far more likely to state things were excellent or good during the Bush presidency relative to their Democrat counterparts. We see that during the late stages of '08, as the recession took hold and the financial crisis took hold, everybody's assessment collapsed downward. But then shortly while staying at an absolutely lower level, shortly following President Obama's election and his inauguration in early 2009, you see, while everybody remained lower in their assessment economy, that Democrats now tended to consistently view the economy or rate the economy more favorably than their Republican counterparts. And this pattern held true for the next 8 years while Obama held office. And then, perhaps coming as no surprise, you see on the right-hand side of the slide, in late 2016, shortly following Donald Trump's election, even before his inauguration in early 2017, Republicans once again were much more optimistic or viewed the economy more favorably than their Democrat counterparts. And so the caution we advise in this is that it's not hard to envision scenarios, and I have vivid recollections of conversations I had with Republicans during the Obama administration that were very reluctant or hesitant to invest based on their views of Obama and his presidency. We also saw many investors following Trump's election of a Democratic persuasion, much more concerned about the state of the economy or more reluctant to invest. And so the point we make is that, this is not without risk, as incidentally during both presidencies, as many of us likely are aware of, we've seen very strong stock market returns. So incidentally, during the Obama presidency, this begins on 1/20/2009, the day he was inaugurated, covering his entire presidency, stocks returned about 15.5% a year. Returns have continued to be quite healthy during the Trump presidency as well. So again, beginning with his inauguration in 2017 through the end of the second quarter year, about 12% per year of return. And so again, this just underscores in our mind the risk of allowing your political affiliation or party views to drive your investment decisions, as we've seen over many centuries, over U.S. capital market history. You've seen very strong and very poor performance during both Republican and Democrat administrations alike, and that it appears that ultimately there's not too much of an impact on capital market returns, depending who's in the White House or who's controlling Congress. So again, we always caution investors to not allow their views to drive too much of their perspective. So that was all we had for today. If you do have any questions, please do not hesitate to contact us. We'd be certainly more than happy to answer any other questions or expound upon these views as you'd like. So with that, we thank you for taking the time to listen, and we hope to hear from you soon. Okay, take care.